Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the extraction era of Vail Resorts, ticker MTN.
It is a fascinating and I have to say a frankly somewhat turbulent time to be looking at this company.
Turbulent is a good word for it.
Yeah, we are seeing um, a complete paradigm shift in how the largest ski operator in the world does business.
Exactly. And just to set the stage for everyone listening, we are looking at a massive pivot here for, the last decade or so. The narrative around Vail Resorts was all about growth by acquisition.
Oh,
It
absolutely.
was a game of risk. Buy a mountain, slap it on the Epic Pass, rinse and repeat. But the thesis we're unpacking today is that the era of conquest is over. We have entered, the era of revenue efficiency.
That's the polite corporate term for it. You could also call it the squeeze.
The squeeze. I like that.
The sources we've pulled together, earnings calls, legal briefings, and some really in-depth industry analysis, they paint a picture of a company that has hit a ceiling on volume.
A ceiling? Meaning what exactly?
I mean, they can't easily find more skiers. The market's pretty saturated. So the strategy has shifted to extracting more yield, more money from the skiers they already have.
And the timing on this is just, it's dramatic. We have the return of the king, so to speak.
All right.
Rob Katz, the former CEO who really built the Epic Pass empire, he has been reinstated as CEO as of late 2025, replacing Kirsten Lynch. He's back to lead this turnaround.
Which is a huge signal in itself. When you bring back the old guard, it usually means the board is nervous.
They want a steady hand on the wheel.
You need stability.
Yeah.
And the core conflict driving that nervousness is what some analysts are calling the pass paradox.
I love that term, the pass paradox. But I have to admit, when I first read the summary, I had to reread it to make sure the math was even right. Let's maybe unpack that right off the top.
Yeah, let's do it. Because ideally, in a healthy business, revenue growth comes from selling more product to more people. It's simple supply and demand.
More widgets sold equals more money.
Exactly. But Vail is currently generating more revenue despite having fewer skiers and selling fewer passes.
Wait, hold on. So fewer people are buying the product, fewer people are using the product, but they're making more money. It seems to defy basic retail logic. How does that math actually work?
Well, they're achieving this through really aggressive pricing, power-raising prices, 7 to 8% on the remaining customers. But, and this is the key, they are doing it while facing two massive headwinds.
Okay.
One is operational decay, which means things are literally breaking down.
Right.
And the second is a landmark, an absolutely tectonic shift in legal liability regarding skier safety.
So they are charging more, delivering less, and getting sued for it, and the stock is going up.
And yet the stock rallied on the latest earnings because the cash flow is still a fortress. It was a very complex picture.
Okay, let's start with the basics then. For anyone who just sees the Epic Pass sticker on a helmet and doesn't really know the business behind it, we need to understand the sheer scale of the empire. What are we actually looking at with ticker MTN?
We are looking at the 800-pound gorilla of the ski industry. I mean, it's not even close. Vail Resorts is the world's largest mountain resort operator. We're talking about a portfolio of 42 resorts across 3 continents.
It's not just Vail Mountain in Colorado anymore.
Oh, far from it. I mean, they own the crown jewels of the Rockies. You've got Vail, Breckenridge, Beaver Creek, Keystone, Crested Butte. They own Park City in Utah, which is by acreage the largest ski area in the U.S.
And they basically own Lake Tahoe.
They dominate it. Heavenly, North Star, Kirkwood, that whole region is basically an epic pass stronghold.
And they've moved east, which, it creates a very different vibe in the portfolio. Those East Coast mountains are different animals.
Very aggressively. They own Stowe and Mount Snow in Vermont, Hunter Mountain in New York, Attitash in New Hampshire. If you know the East Coast, these are the heavy hitters.
Hunter is where New York City goes to ski.
Exactly. It's gritty. It could be crowded. Stowe is the opposite. It's the luxury destination. Then you go north, and they own Whistler Blackcomb in Canada, which is arguably the premier resort in all of North America.
And now they're global.
Now they're global. Recently, they've expanded into Switzerland with Andermatt-Sedrun in Crans, Montana. Plus, they have Perisher and Hotham down in Australia for year-round skiing.
It's a global footprint. But here's the thing that always gets me, and I think it's the core of their business model. They aren't just selling you a lift ticket.
Not at all.
It's not like buying a ticket to a movie theater where you watch the movie and you leave.
No, and that's what they call the integrated model. The whole idea is to capture the full guest spend.
Okay, let's illustrate this. Let's just walk through a hypothetical. Imagine a family, let's call them the Smiths. They land in Denver for a ski trip.
Okay, so the Smiths land. They take a shuttle up to Breckenridge. That shuttle. It's often owned or has a direct partnership with Vail.
Colorado Mountain Express, something like that.
Exactly. They get to the mountain. First stop, they need rental skis for the kids. They go to Vail Sports, owned by Vail. They check into their hotel. It's likely a rock resort or at least a property managed by Vail.
The kids need lessons, obviously.
Ski school. That is a massive, massive margin business. And it is 100% owned and operated by Vail. Lunchtime comes around. They go to the cafeteria at the top of the mountain, buy $25 burger.
$25. Easy.
Owned by Vail. They want a souvenir hoodie at the gift shop before they leave. Owned by Vail.
So every single swipe of the credit card, from the moment they land to the moment they get back on that shuttle to go home, it goes into one bank account.
That is the goal. Every dollar. And the glue holding all of that together is the Epic Pass ecosystem. This is the moat around the castle. The whole strategy is called advance commitment.
Advance commit.
They don't want you checking the weather report on a Friday morning to decide if you're going skiing that weekend. They want your money in September, non-refundable.
It's basically a gym membership, isn't it?
That's a great analogy.
You pay for the whole year in January, and honestly, from a financial standpoint, they benefit even if you don't show up. The cost to them is lower if you stay home.
That is a cynical way to put it, but financially, yes.
Yeah.
That's exactly the model. The stats from the latest reports show that the Epic Pass locks in roughly 74% of all skier visits before the season even starts.
74%.
Think about that. That creates incredible stability. It could be the worst snow year in history. Doesn't matter. They already have the cash in the bank.
But to get to this size, to get to 42 resorts and that level of market power, they had to go on a massive shopping spree. And this is where the story gets a little murky. This brings us back to that growth by acquisition era we mentioned.
Yes. And to really understand the current extraction era, you have to understand how they consolidated the market so quickly. And there's a specific chapter in this history that involves a very controversial financial intersection.
Okay, I want to pause here because when I was reading through the source material you sent over last night, I got to the section on the Peak Resorts acquisition, and I literally had to put my coffee down. I thought it was a typo.
The financing behind that deal.
The financing. We're talking about the consolidation of the entire Northeast Hunter, Mount Snow, Attitash, all these places everyday people ski. But we need to talk about whose money actually paid for that consolidation. It's unbelievable.
It's not a typo. You are looking at the Sackler family.
The Purdue Pharma Sacklers. The family behind OxyContin and the architects of the opioid crisis.
The very same. The sources we have, they indicate a direct financial link between the profits from the opioid crisis and the consolidation of the Northeast ski market.
Walk us through this carefully, because it sounds insane. How did OxyContin money end up buying ski hills?
You have to go back to around 2018. There was a publicly traded company called Peak Resorts. They owned a lot of those regional hills near big cities. Hunter Mountain near New York, Mount Snow in Vermont, Attitash. They were trying to expand, but they were a smaller company. They needed capital.
And at the same time, the Sacklers needed a place to put their money. A place that was maybe less scrutinized than Purdue Pharma.
It certainly appears so. In 2018, while they were facing this mounting wave of lawsuits regarding the opioid crisis, the Sackler family injected $76 million into Peak Resorts.
$76 million.
And that injection gave them a controlling interest in the company.
So they basically bought the company. It was their asset.
Effectively, yes. They were the power behind the throne. And then, just a year later, in 2019, Vail Resorts comes knocking. They want to buy all those feeder resorts near New York and Boston to sell more Epic Passes to city dwellers.
So Vail makes an offer.
Vail makes an offer to buy the entire Peak Resorts company for $264 million.
And that was a premium price, right? I remember reading that.
Huge premium. Vail paid $11 per share when the stock was trading around $5.
They paid double, more than double.
More than double the market price.
So the Sacklers, who owned this huge controlling chunk of shares, they made out like bandits.
The reports we reviewed estimate that that deal resulted in an $87 million profit for the Sackler family.
$87 million.
In 1 year, on that one investment.
Yeah. While Purdue Pharma was basically burning down, while communities across the country were being devastated by the very product that created that wealth, that's just hard to swallow.
It represents a massive, and you could argue very troubling, transfer of wealth. Wealth that was arguably derived from a public health tragedy, transferred directly into the infrastructure of the American ski industry, and Vail Resorts wrote the check. that cashed them out.
Wow. Okay. So Vail writes the check, the deal is done, and then Vail takes over these resorts. What happened to the experience at those mountains after the acquisition? Because if you're a skier in the Northeast, you probably noticed a change, a big one.
Well, this is where the consumer, the everyday skier, starts to feel the impact of that growth by acquisition model. As soon as Vail took over, the #1 goal was to drive Epic Pass sales.
Right.
They wanted everyone on the pass. So to do that, they jacked up the window ticket prices to make the pass look like a no-brainer.
They make the alternative so expensive that you're forced onto the subscription.
Precisely. We saw weekend lift tickets at a place like Mount Snow jump from around $110 to over $185.
Almost $200 to ski in Vermont on a Saturday. That pushes the sport out of reach for a lot of families and makes it a luxury good.
It does. And at the same time, because everyone in New York and Boston who had an Epic Pass now had access to these mountains, the crowding became severe.
I've heard the stories.
There were reports describing Hunter Mountain feeling more like an amusement park than a ski resort. You know, hour-long lift lines, chaotic slopes, just a dangerous density of people. The acquisition strategy, it worked for the balance sheet, but it started to significantly degrade the actual product.
So we have this amusement park chaos on the slopes. You'd think that would have to hurt the bottom line, right? If the product is getting that bad, the sales should drop. But this brings us back to the money. Let's look at the bank account. As of Q1 2026, is the company actually healthy?
Financially, they are an absolute fortress. Let's break it down. As of the first quarter of fiscal 2026, mountain operations, so that's lift tickets, ski school, food, all the on-mountain spend, that makes up about 89% of their revenue.
The vast majority.
The vast majority. The rest is lodging and a little bit of real estate development.
What about debt? I mean, buying 42 resorts isn't cheap.
No, it is not. Total debt sits at approximately $3.4 billion.
Billion with a B.
With a B. Net debt, which is debt minus cash on hand, is around $2.8 billion.
Okay, so that's a big number. And the notes say the leverage ratio is between 3.0 and 3.2 times EBITDA. Pause there. 3.2 times EBITDA. For the listener who doesn't stare at balance sheets all day, is that a red flag? Is that maxed out credit card territory, or is it more like a heavy mortgage?
That's a great question. It's definitely more heavy mortgage than maxed out credit card. In the corporate world, anything under 2.0x leverage is considered very safe, very conservative. Once you get over 3.0x, you're getting a little aggressive, especially now that interest rates are not zero anymore. It just means they're carrying a significant load relative to their earnings.
So it's manageable, but it's tight.
It's manageable for one key reason. Their liquidity is immense. They have about $1.5 billion in liquidity.
What does that mean, liquidity?
That's cash on hand plus what they can immediately borrow from their credit lines. It's their emergency fund. It's enough to weather pretty much any storm, a bad snow year, a recession, you name it. And on top of that, you have to remember, they pay a very, very robust dividend.
Right, and that's the lure for investors, isn't it? The income.
That's the hook. $2.22 per share every single quarter. That works out to a yield of roughly 6%. In this market, finding a reliable 6% yield is incredibly attractive. It appeals to pension funds, retirees, income investors. This is why the stock has so many defenders, even when the operations are clearly struggling.
But let's go back to that past paradox. Because the latest numbers, the Q1 2026 numbers, they show something really interesting happening with the customers. This is the core of the new strategy.
This is the key metric. You have to focus on this. Pass units sold. So the number of individual passes they sold, that declined by 2%.
So fewer human beings bought an Epic Pass this year compared to last year. The line went down.
The line went down, but pass revenue went up 3%.
So fewer people, more money.
Exactly. They hiked prices by about 7 to 8% on average, and this proves they have immense pricing power. They are effectively, and this is the key phrase, decoupling revenue from volume.
Decoupling revenue from volume.
They don't need more skiers if they can just charge the existing loyal ones significantly more money every year.
That sounds great for Wall Street. I mean, if you're an investor and you can sell less stuff for more money, that's the dream. But there's a massive risk there, right? You can only squeeze that lemon so hard before you run out of juice.
That is the extraction era risk in a nutshell. And the reason investors are nervous, despite that juicy 6% dividend, is that while the financial engineering is working, the physical reality of the resorts is, well, in some cases it's crumbling. This is the reckoning section of our analysis.
Yeah, let's talk about the operational decay. Because if they're making all this money, why was the previous CEO, Kirsten Lynch, ousted? Why did they have to bring back Rob Katz? It doesn't add up.
Because under Lynch, the intense pursuit of efficiency started to look a lot like negligence. The sources we read describe a penny-pinching mode that had, in some cases, catastrophic consequences.
The Park City strike, that felt like a turning point.
As a watershed moment, December 2024. The ski patrol at Park City, one of their flagship marquee resorts, went on strike. Now, you have to understand, ski patrol aren't just the people who tell you to slow down in a slow zone.
No, they're the first responders.
They are the paramedics of the mountain. They do avalanche control with explosives in the morning. You literally cannot open the mountain safely without them.
And it was the first major ski patrol strike in, what, 50 years?
A very long time. And the company's response was, well, it was aggressive, to say the least. Management tried to break the strike by using scabs.
Scabs?
Yeah, they flew in patrollers from other Vail resorts around the country to cover the shifts.
Just imagine that. You're a patroller from a small hill in the Midwest, maybe Ohio, and they drop you onto the largest, most complex resort in America and tell you, go make sure this is safe. It's insane.
And it backfired spectacularly. The stories from that time are incredible. You had guests in the lift lines actually chanting, "Pay your employees." You had huge swaths of terrain that had to remain closed because the replacement workers, well, they didn't know the mountain well enough to open it safely.
The brand damage from that must have been immense.
It was huge. It just reinforced this growing narrative that Vail cares about the stock price, not the ski experience or its employees.
And it wasn't just labor issues. I mean, things were actually
Dangerous things. The sources we have highlight specific terrifying lift accidents that were attributed to deferred maintenance. At Heavenly in Tahoe, a chair slid backward on the line while people were on it. At Attitash in New Hampshire, a chair literally detached from the haul rope and fell.
That is the absolute nightmare scenario for any skier. You're dangling 30, 40 feet in the air, and your only thought is trusting that the machinery works.
Both of those incidents resulted in hospitalizations. And this isn't just bad PR anymore. It connects directly to the second major headwind we mentioned, the legal shift.
This is the Miller verdict. I feel like this hasn't gotten enough mainstream attention, but for the ski industry, it's an earthquake.
It absolutely is. This is the case of Miller v. Vail Resorts. It involved a 16-year-old girl who was tragically paralyzed after falling from a lift at Crested Butte.
Just awful.
Extremely. Now, for decades, whenever you buy a lift ticket, you sign that waiver.
Yeah.
You know, the page is a fine print that nobody ever reads.
Right.
The one that essentially says skiing is inherently dangerous. If you get hurt, it's tough luck. You can't sue us.
It's been the industry's get-out-of-jail-free card. It's been the standard for decades.
It was. Until the Colorado Supreme Court ruled on this specific case, they established a legal concept called negligence per se.
Negligence per se. Okay, let's unpack this. What does that actually mean in plain English for you and me?
In plain English, it means that if a resort violates a state safety law or a specific regulation, like, for example, failing to maintain a lift properly according to the legal code, the waiver disappears. Poof, it's gone.
So you can't have a contract that lets you break the law.
You cannot contract away your legal duty to follow the law. So if a lift breaks because you didn't maintain it, and the state inspector comes in and says, you violated safety code 123, the fine print on the back of your lift ticket doesn't save you anymore.
And the payout in that case?
The jury awarded the victim $12.4 million.
Wow, that's a game changer.
Now, connect the dots. We just talked about Heavenly and Attitash having major accidents that are specifically being investigated for, you guessed it, deferred maintenance. Under this new Miller precedent, Vail is facing potentially uncapped liability exposure. Their legal shield is gone.
So let's just recap this section. You have a company that is alienating its core workforce with strikes. You have critical infrastructure that is physically failing in dangerous ways. And now you have a new legal environment where those failures can cost you tens of millions of dollars per incident.
And that right there is why Rob Katz is back.
The return of the king. Late 2025, the board looks at all this and says, enough. They bring back the guy who built the empire in the first place, but he's not coming back to buy more resorts, is he?
No. His mandate is completely different this time. He is pivoting the entire corporate strategy away from growth by acquisition and towards revenue efficiency. This is Katz's Playbook 2.0.
And he's bringing in some heavy hitters to help him. We need to talk about the money architect, as you called her.
Celeste Burgoyne. This is a really fascinating hire. She was formerly a top executive at Lululemon. She's coming in as Vail's first ever chief revenue officer.
Lululemon, that's yoga pants. What does the yoga pants business have to do with the ski business?
Think about the Lululemon business model. It's not really about clothing. It's about creating a cult-like loyalty.
Right, it's a lifestyle brand.
It's about community, it's about brand obsession, and it's about generating massive, massive margins on that loyalty. Lululemon didn't just sell leggings, they sold a membership to a lifestyle. Vail wants to do the exact same thing. They want to bring that cult loyalty tactic to the Epic Pass.
So what does that actually look like on the mountain? Are we all doing yoga in the snow before our first run?
No, it looks like data. It starts with something they call dynamic pricing, or agile pricing is the new buzzword. The days of static, predictable ticket prices are ending. They are moving to a model where the price fluctuates based on real-time demand.
You mean like Uber surge pricing?
It's exactly like Uber surge pricing. If it's a Tuesday and it's icy and no one's there, maybe the price drops to get a few more bodies on the hill. But if it's a Saturday and there's 12 inches of fresh powder,
that price is going to spike.
it's going to spike. They want to capture what they call the surplus value of that perfect powder day.
So the rich get the powder and the rest of us get the ice.
That is the cynical interpretation, yes.
Yeah.
But from a business perspective, it's about maximizing the yield per skier day. And they're using technology to do it. They are turning the My Epic app on your phone into what they call a hyperactive concierge.
I saw this in the notes, the data concierge. It sounds a little dystopic, to be honest with you.
It's highly sophisticated. I mean, just imagine you're out skiing. The app knows where you are on the mountain. It tracks your vertical feet, your speed, your location, which runs you're taking. It sees you've been struggling on a beginner run. Maybe you've fallen a few times. Boom, your phone buzzes. You get a push notification. Hey, tough run. We see you're struggling. Here's a 20% discount on a private lesson starting in 30 minutes at the base.
It's watching you ski badly and then trying to sell you a fix for it. That feels incredibly intrusive.
Or, another example, we see you're approaching the Midvale Lodge and it's 11:30 a.m. Here's a coupon for a free soda with your burger if you come in right now.
Because they want to spread out the lunch rush and improve efficiency.
It's all about using your personal data to smooth out their operations and to extract that extra $10 or $20 from your wallet at the precise moment you're most likely to spend it.
It's the monetization of every single moment on the mountain. And Katz also mentioned that the old way of marketing, just sending emails, is dead.
Yes. He was very blunt about it on the earnings call. He admitted that their traditional email marketing, hey, buy a pass before the price goes up, is failing. The open rates are dropping. People are just tuning it out.
So what's the pivot?
They are shifting massively to paid media, specifically to TikTok and influencer partnerships.
They're trying to get Gen Z on board, trying to make skiing look cool again.
And trying to reduce friction. This part is actually pretty smart. They are integrating lift ticket purchases directly into the Uber app.
Wait, really? In the Uber app?
Yes. The idea is to capture the casual, spontaneous traveler. You land in Denver, you book your Uber to the mountain, and right there in the same flow it says, hey, want to add a lift ticket for Breckenridge to your ride?
That is smart.
It removes the barrier to entry. If you make it incredibly easy for people to spend money, they will spend more money.
Okay, so we have the new tech, the new marketing, the new pricing strategies, but all of this costs money to implement, and yet they are cutting costs aggressively elsewhere. This brings us to the resource efficiency plan.
This is the other side of the ledger. It's the classic business pivot. You can increase revenue or you can decrease costs. Katz is doing both at the same time. In that same Q1 2026 earnings call, they announced a plan to save $100 million annually.
That is a very big number. Where is $100 million coming from?
Mostly people. They are cutting 14% of the corporate workforce.
Ouch. 14%. That's a lot of jobs.
At a very significant reduction in headcount. And this brings us right back to the central risk of this entire turnaround. We just talked about the lift accidents. We talked about the ski patrol strike. Those were, at their core, failures of staffing and maintenance.
Right. And if you cut 14% of your support staff, your corporate staff, do the lifts suddenly run better? Does the customer service get faster? I doubt it.
That is the execution risk. That's the billion-dollar question. Can you cut your way to growth? The fear is that by slashing the workforce to save that $100 million, you will inevitably further degrade the guest experience.
The experience that's already suffering.
Exactly. Lines get longer. Phones don't get answered. Lifts break down more often because maybe there aren't enough engineers or mechanics overseeing the maintenance schedules from corporate.
It feels like a vicious cycle. You cut staff to save money, which makes the experience worse, which makes people angry.
And if the experience gets worse, then the past paradox might finally break. Right now, people are tolerating the higher prices because they feel locked into the ecosystem. or they just love the mountains. But if the product becomes undeniably consistently bad, skiers might finally defect
To the Icon Path.
to the Icon Pass, which is run by Alterra, to smaller independent mountains. Or they might just stop skiing altogether. The volume ceiling we discussed, that 2% drop in pass sales, that suggests that people are already starting to vote with their wallets.
So bringing it all together for a final verdict, we're in the extraction era. Vail has conquered the map. They own the mountains. Now the strategy is to mine their own customer database for every last dollar.
It's a fundamental transition from a land grab strategy to a yield management strategy. They've hit the limit of how many new skiers they can find, so they must make more money from the ones they already have.
So from an investment perspective, how do we look at this? What's the final analysis?
It's a battle between the balance sheet and the brand. The Fortress balance sheet is very real. That 6% dividend is supported by recurring, locked-in revenue from the Epic Pass. And that is very, very attractive to a certain type of investor who just wants that steady cash flow.
The portfolio protected part of our slogan.
Exactly. But the risk-defined part is the execution of this cat's turnaround. If they push the extraction too hard, if the pricing gets too aggressive while the lifts keep breaking and the lines keep growing, they risk destroying the very loyalty that the entire business model is built on.
It's a high wire act. They need to squeeze the lemon without completely crushing it.
And they need to do it while navigating this brand new legal landscape that punishes them severely, financially, for any operational failures.
It's going to be a fascinating couple of years for ticker MTN. And here's a thought to leave you with something to mull over. We talked about the app acting as a hyperactive concierge, but what happens when the algorithm, in its pursuit of efficiency, decides that you are not a profitable skier?
That is the dark side of all this data.
Does the dynamic pricing model eventually start firing customers, pricing out the locals who ski 100 days a year, but they pack their own lunch and don't buy burgers, in favor of the wealthy tourist who only skis 3 days but buys a new jacket and takes a private lesson? If pure efficiency is the only goal, the soul of the sport might be the next line item on the cutting room floor.
A very sobering thought.
As always, thank you for listening to Griffonomics, Risk Defined.
Portfolio protected.